What is up, everybody? I'm going to do a little bit of a change of direction today because I want to test the YouTube market to see who wants this day-to-day financial news, financial research, and the market changes by the day, by the hour. And as a trader, I stay on top of the market. I stay on the pulse of the market. But also, my history is in portfolio management as well. And I wanted to go over a scenario I think maybe some subscribers, some people might find value in how to distribute your wealth over a portfolio. I know many people aren't aware of that. Many people pay a financial advisor for that. I myself have passed all three levels of the CFA, and the third level was predominantly, I'd say 80% on portfolio management. And I never really used that going forward. And I thought I could add value as somebody, YouTube is the overwhelming finance crowd on YouTube is technical analysis, right or wrong, right? And that's not a bad thing. Like the Australian kid, I don't know his name, Eric Crown, Benjamin Cohen, technical analysis heavy. And I bring something different. I bring fundamental analysis. I bring the why. Fundamental is the why of why price moves. Technical is past trades setting up the future and using probabilities to look in the very near term future on what might or might not happen. And fundamentals will tell you, well, the PE is 15 and the earnings were 5, so the price is 65. It'll tell you the why of why the price is moving up or moving down. And that's what I've always been attracted to. And that fundamental stuff led me to the CFA and my MBA, where I pretty much mastered portfolio management. So let's just get into it. I took a 40-year-old average working male right down here. And I did 40 years old because it's kind of mid-career, midlife. And 40 is the midpoint between 30 and 50, and 30 and 50-year-olds can borrow this portfolio. It's okay. But if you're 20 or 60, you can't borrow this. Your risk aversion and your return requirement will be way different. What does that mean? It means when you're 20, you can take more risk. When you're 60, you can't. You're retiring, or you're at the end of the trail in terms of career, and you're looking at the next 20 years, so you want money for the next 20 years. And then maybe if you want to leave money to your kids or whatever, blah blah blah. But I'm just talking strictly portfolio management. When you're 60, you have 20 years. You don't want the volatility of a commodity or a cryptocurrency or even stocks, like small cap stocks. So that portfolio will be very, very different from somebody that's 22 years old and right out of college, and pretty much can take on risk, needs to take on risk, so they can get that risk-adjusted return. For this specific case study, I'm just going to look at a 40-year-old with two kids. That's like the average family, and a time horizon of 20 years. So he's going to get to 60. His time horizon here is 20 years, so it's a normal market cycle of equities is 20 years. And I'm assuming he has a mortgage, so I'm assuming he wants to play it a little bit safe, because if you have a mortgage, you don't want to go all in shitcoins, right? Or even all in emerging markets. You want to be balanced. And this is a model CFA, Chartered Financial Analyst portfolio, where it's a balanced portfolio, but if you add these up, 35, 15, and 7 and 8, that's 65% right here. Equities are 65% of the portfolio. Other is 10%. Other is like REITs, real estate investment trusts. So you're having like the liquid portion of a real estate investment. And then commodities, which are quite volatile, and but they also represent diversification from equities. The commodities like gold and silver, they can pass through inflation. What does that mean? It means if inflation rises, the gold bar should rise more, because it's a risk trade, risk off trade. So commodities, rare earth, silver, gold, platinum, palladium, copper, they can all pass through inflation, and you want that. And then for the cash via bonds, your cash is like 25% of your holdings, and that can be reallocated to stocks. If you get a 30% pullback, you can put You can reallocate that. So that's very flexible money, and it's money that's earning a yield. Intermediate treasuries are going to be really low risk. Investment grade corporates will be a little bit higher risk bond. Treasury inflation protected securities are protection against inflation. So that's really cool. And you have the easy access ETF here. So I've given you the ETF. You can go do your own research. Say, oh, I'm expecting inflation over the next 10 years because all America does is inflate their currency. So I want inflation protected securities. You're going to get a bond that pays a yield and then protects you in case of inflation. So if your yield is 4 and inflation is 6, you're going to get a 4 plus, 2% plus another yield. You're going to get a bond that strips out inflation. So if inflation is 6 and your bond is 4, you're going to get at least 6%. So that's really interesting. And Treasury inflation protected securities. And global REITs, real estate investment trusts, they can perform really well. And that's kind of like a minority portion of your portfolio. But over the long term, stocks outperform everything. It's a fact. You can look it up. Grok it. ChatGPT it. Stocks outperform everything with dividends included. The return expectation is the highest in stocks. I am very bullish on commodities going forward in the next 20 years because I view the world as being inflationary and also in those commodities to pass through inflation. So it's a speculative idea. I might not be right. But when I say stocks outperform everything over the long term, 20, 50, 100 years, I'm right because the data proves that. So that's really what I wanted to talk about here. That's kind of all I have. I just want to keep it short and sweet and kind of like off the cuff or fringe from the other emergency updates, PCE, CPI, gold, silver, commodities, energy, inflation booms, blah, 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 blah. I wanted to I know some of my subscribers are into portfolio analysis, so I want to do that for them. So if you find value in this, if you like it, if you want me to go maybe deeper on another broadcast, leave a like, leave a subscribe. If you're here to the end, you win $2 million. So comment that and comment what allocation of your portfolio is equities. I think that would be interesting to know and to respond to. Thank you very much for listening to the end if you've stayed, and I will see you in the next one.